Hello, I'm just wanting to do a video to show the solution process for the assignment number 4 for International Food Business Finance course. Okay, so we're going to go through the assignment step by step, and hopefully you'll be able to find out from that where you might have made a mistake, or or congratulate yourself at having done so well. Okay, the question is laid out. You're given a beginning balance sheet for this business. The assets, this is a balance sheet that's organized in the international format, and you're asked in this question to put your answers in the North American format, so that will be part of what we have to consider. Number of different types of assets, non-current assets, inventories, also under current assets, inventories, trade accounts, receivables, prepaid expenses, cash, owner's equity, there's trade payables, accrued wages. You should start by being aware of what account balances already exist, because of course when you move from one period to the next, the account balances in the balance sheet, both assets and liabilities, continue on and often become part of the question itself. So let's start by discussing all of the various transactions that you're asked to deal with. Number 1, the owner withdrew $20,000 from the business bank account to gamble at the casino. So first thing to do, because this is an asset that we're dealing with in terms of cash, is to look at the existing account, as I've just mentioned. So cash is $8,300 already to start with. So cash is $8,300. The owners withdrew $20,000. Okay, so that withdrawal is a reduction in cash, and it will be also a drawing, an owner's drawing, or withdrawals, sometimes it's referred to, is minus 20. Sorry, don't put minus here. Keep this as because drawings will be subtracted eventually, but in these accounts, all we're trying to do is look at increases in the accounts are positive and decreases are negative. And that way we won't get mixed up with where everything goes and how it adds together. All right, so drawings go up 20,000, cash goes down 20,000. He lost all of the money except for 5,000, which he then reinvested in the business. So he put 5,000 back into the business, and that's a contribution now. Now obviously you could have just said, well, the net difference is 15,000, but from an accounting standpoint and also from a finance standpoint, it's useful to look at these numbers as separate transactions, because in fact they were. So it's too early at this stage to start to subtract and take net values. Building premises continued to be rented on an annual basis of $20,000. During the year, rent of $25,000 was paid to the owner. Okay, so we're told there, first of all, that building rent is $20,000 a year. So rent expense is $20,000, but $25,000 for rent was paid by the owners. So that's cash. So cash went down $25,000. Now we're out of balance by 5. We've accounted for the $20,000 here in rent expense, but $25,000 is the amount. So the extra 5 is rent that you've paid in advance for next year. Okay, so because we only had to pay $20,000, the other 5 will carry over to next year. And to make that carryover happen, it's called a prepaid. So we have prepaid rent. Is $5,000. Okay, so now those series of transactions balance. Fees, maintenance, snow removal, lawn mowing, that sort of thing on premises that are rented, were paid during the year as follows. For the period of April 1st to March 31st, 2015, they paid $2,000. Now, that looks like there probably would be a prepaid expense from the previous year, because April 1st is the start of the second quarter of 2014. We need to have something for the first quarter also. So let's start with that, prepaid fees. Prepaid fees on the balance sheet are $400. Okay? So the first thing we're going to do is bring that to zero, because that appears to be the fees for the first quarter of the year. So we're going to remove that from fees, and we're going to have a fees expense. So fees expense is going to go up $400, and that's the balance of this account. This was the original amount that was in prepaids. We've subtracted $400 because now we're going to expense that prepaid. Now that's not all. Because we paid $2,000, for the fiscal year April 1st, 2014 to March 31st, 2015, that's 4 quarters, that's a full year, it's 4 quarters, and if you divide 4 quarters into 2,000 or 4 into 2,000, you'll get a fees expense of $500 per quarter. So 3 of those quarters will be an expense in 2014, so we'll add $1,500 to this account, and the remaining $500 is for the first quarter of 2015. So that's the same as this $400 was originally there, so we'll add $500 to prepaid fees, which will end up on the balance sheet when we're done. Okay, so the $2,000 has been accounted for, this $500 and this $1,500. We also have accounted for the prepaid that was left over from the previous year. Additional equipment was bought on January 1st for $15,000. Okay, now I'm just going to call machinery and equipment, put it in the same category. You don't need to do that. You can separate it if you wish. It's just some extra calculations, but it won't affect whether the balance sheet balances at the end. So we have machinery, net machinery, that already exists of $25,300. We're going to add to that $15,000 worth of more machinery or equipment. Okay, now that $15,000 we need to balance off. $5,000 of that was cash, so cash goes down $5,000, and $10,000 was taken out in a 5-year term loan at the bank. So we can add term loan now, and sometimes to know what the loan is for, we can say term loan equipment, term loan machinery, but in this case there's only one term loan anyway. So that was $10,000. Okay, so now this balances. We have the $15,000 machinery purchase, and we paid for it with a $10,000 loan and $5,000 in cash, so that's $15,000 also. We're not done yet though. There's an annual payment on principal of $2,000 each December, so we're going to pay $2,000 back on the loan at the end of the year, and that $2,000 will come off the principal balance of the term loan. In addition, there's an interest charge of $500. So the 500 of cash, and that's interest expense on the income statement. This is the cost of borrowing. Interest expense is 500. That's enough of that one. Wages totaling $23,800 were paid during the year. So let's start by putting that number here, because we know that was paid in cash. So 23,800 was paid in cash during the year. At the end of the year, employees had earned $860 of wages for the last week of the year, but that would not be paid until January. Now this one's a little complicated because there's an accrued expense, which is wages. So the accrued expense, we're going to keep this in mind up here. Let's talk about accrued expense. Is 1,700 on the balance sheet to start with. It's a liability, and what that means is that the pay period, the actual day that the pay gets paid in cash to employees, happened after year end. So let's say that these workers get paid once a month in the middle of the month. Well, they would have been paid on December the 15th, but then they would have worked the last 2 weeks off December and off the year, and they're not due to be paid for that until January 15th. So the amount is still an expense in the year that the workers work, because it's related to the sales of that year. So $1,700 was on last year's expense income statement as an expense, but that hasn't been paid yet in cash. So an accrued means that it's been expensed, but it hasn't been paid in cash. So this 23,800 is 1,700 of that is represents the payment now of those fees. Okay, so 23. We're going to take that 2380. We're going to subtract 1,700 for prepaid, or sorry, accrued expense, which leaves us with 22,100. That represents the wages that have been paid in cash during the year that we're dealing with. So when we look at a wages expense, remember that 1,700 was wages expense last year, so it's not, we don't duplicate that again. But this 22,100 is wage expense during the year. It also goes on and says that at the end of the year, employees had earned $860 of wages for the last week of the year, but would not be paid until January. Okay, now, what I forgot to do when we subtracted the 1,700 here is that we also have brought the accrued wages to zero, because we've looked after those payments. But now we're going to have another 860 of wages that have been earned but not paid yet. They'll be paid in 2015. So this also represents part of wage expense for this year. Okay, so it's a wage expense, but it won't be paid until next year. So that'll show up on the balance sheet. Number 6, electricity bills for the 4 quarters of the year were paid, totaling $1,700. So electricity expense is $1,700, and that comes off cash. Get rid of that note taking. Inventories totaling $143,000 were bought on credit. So inventories is on the balance sheet. So we started off the year with inventories of 12,200. 12,200. We're now buying an additional $143,000 worth of inventory, and we're doing it on credit. When you buy inventory on credit, that impacts accounts payable. So we again look at the opening balance sheet to see if we had existing accounts payable, and we do, 16,900. So trade or accounts payable are, what did I say? 16,900. 16,900 to begin with, and we just added 143,000 more to that, those payables. Inventories totaling 12,000 were bought for cash. So cash goes down another 12,000, and inventories increase by 12,000. So that one's fairly straightforward, I think. Sales revenue on credit totaled $211,000. So just stop there when you get to this type of question. Look at the revenue. Okay, so we're going to have sales of 211,000. These were all on credit. Okay, so when you sell something on credit, that's an accounts receivable. So we'll have accounts receivable. Let me move up here. Accounts or trade receivables starting off the year were 21,300 on the beginning balance sheet, 21,300, and now we've increased that by 211,000. I think that's all that did. Cash sales revenue totaled 42,000. Oh, sorry, let's go back to 9. We haven't finished with it yet. We looked after the sales revenue aspect, but we also have to consider the fact that that came out of inventory. What we sold was in inventory. And the value that it was in inventory, the cost value, was 127,000. So inventory goes down 127,000. And the cost, because that represents the cost of what was sold, and we know that cost of goods sold is part of the balance, or part of the income statement. So cost of goods sold goes up 127,000. Okay, number 10, we have more revenue, but it's cash sales this time, so 42,000 increase in sales. That all came in cash. That's a 2. That came in cash, 42,000. It took 25,000 out of inventory and moved it to cost of goods sold. Receipts from trade receivables totaled 198,000. So we got 198,000 in cash coming into the business, and our trade receivables went down 198,000. That's an 8. Payments to trade payables totaled 156,000. So we paid 156,000 on our accounts payable, which are down here. So this reduces it by 156,000. and also, of course, reduces cash. And finally, in this regard, machinery operating expenses paid totaled $17,500. So machine operating expense was $17,500. So that's paid out of cash. Now, the reminder here is that the business uses reducing balance method for depreciating non-current assets at the rate of 30% a year. Okay, so that calculation is we take our total equipment, and because this original $25,300 says net beside it, that means that the accumulated depreciation has already been subtracted from the balance. And this other $15,000 is new. So we add these initially together, and we get, let me just change to a different color. Okay, so this is $40,300 of total machinery at the net value at the start of the year. Because now what we're going to do is multiply that by 30%. So multiply it by 0.3, and that will give you 12,090. Let me write that a little clearer. That gives you 12,090. Okay. That represents your depreciation for the year. So up here we're going to put depreciation expense. And this has nothing to do with cash. Like the cash is long gone. This is strictly an allocation that we talked about when we studied depreciation. So depreciation expense is going to be 12,090. And the other half of that transaction is actually putting it into accumulated depreciation. Or in this case, we're just going to subtract it from the 40,300. So 090. So we have 210. Right? Yeah. So 28,210 is going to be the net amount that's left over for equipment. So let's just put that here. So 40,300 minus 12,090 is equal to 28,210, and that is the number that we're going to use in the balance sheet. All right, so we're pretty much ready now, I think, to finish the question. First thing we have to do is add up all of our numbers to see what they end up as. I happen to have this done on a sheet here. And the first thing that happens is we discover that when we add up to get the balance for cash, it's a negative number. So the cash ends up being a negative $12,200. You cannot have negative cash in a business. If you do, you're done. You have to pay the bills, or you get forced out of business and through bankruptcy or some other procedure. So in order to balance this, and all you need to do is bring it to zero, is we need to borrow some money. So we take a bank loan. Let's check and see whether there's one already. No? So we'll take a short-term bank loan. Can be called line of credit, demand loan, revolving loan. There's different names, but it's a short-term thing to cover off these types of cash issues. So we're going to borrow $12,200 from that. from that bank, from the loan, and that's going to reduce our cash, so it'll be another a reduction of $12,200, which will bring our balance to zero. Okay? So if you run out of cash, you have to find it somewhere. The other option you could assume, I mean, this is just an assumption here, you could assume that the owners are going to contribute $12,200 to bring the cash to zero. That would be perfectly valid if you decide to do it that way. And there's no magic of just borrowing $12,200. Sometimes businesses like to have a little bit of cash reserve just in case something happens. So they may want to borrow $15,000. Again, anything that you decide, as long as you balance the accounts off properly, will keep your balance sheet in balance, and it's perfectly a valid assumption. A few of the other totals here. We have accounts receivables total is $34,300. Prepaid. What else? Inventories end up being $15,200. Accounts payable, $3,900. Accrued wages end up with $860. Wage expense is $22,960. What are the calculations that we have? Cost of goods sold. Can't find it here. Oh, here we go. Cost of goods sold, $152,000. Term loan is $8,000 because we took out $10,000, made a $2,000 payment. Fees expense is $1,900. Prepaid fees is $500. Okay, so these are all balances for the accounts. That's pretty well it for the ones. All the rest of them just had one aspect of one number in them anyway, so we can continue. So I have to prepare the board for the income statement, so let me do that. Please take note of the numbers that we have in the balances, because of course we'll use those in our next steps, the next couple of steps. So all the numbers we're going to be using now are from those balances. So the income statement. Normally you put the business name, as you know, but there is no name given. Income statement for the year end December 31st, 2014. Okay? So we had sales of $253,000, less cost of goods sold, which was $152,000, which gives us a gross margin or gross profit of $101,000. Okay, so this is the start of a column. We'll put a dollar sign there. Now we have expenses, and expenses included electricity, of 1700. This is a new column, so we'll just do a sub-column for expenses. There were operating expenses, machinery operating expenses of 17,500. Rent was 20,000. Fees 1,900. Interest was 500. Wages 22,960. And depreciation was 12,090. Okay, so total expenses were $76,650 for a net income equal to $24,350. Double underline because it's at the end, and we have the balance sheet. Now, I didn't ask you specifically for a statement of owner's equity in this case, but you do need to calculate the equity number, and let's do that just here on this same board before we do the balance sheet. And so the statement of equity which also is for the year ended December 31st, 2014. And we have beginning equity or capital, they're used interchangeably. From the balance sheet is 48,900. Less drawings, which was 20,000. So that reduces equity. Put 5,000 back in contributions. Was 5,000. And we also had net income of 24,350. So our ending equity number is 58,250. So this is the number that'll go in the balance sheet now that we're ready to prepare it. So remember, the connection between the income statement and the balance sheet is right here. Okay? And then this equity number also goes into the ending balance sheet. So remember the net, the ending equity, because we'll need that in a second. And let's clear the board for the last step. All right, so now we're working on the balance sheet, which is the ending balance sheet for the year, so we have to recognize that in the date. So the balance sheet on December 31st, 2014. Start with assets. All right, so you were asked to prepare a classified balance sheet, which means we're going to figure out what the current assets and what non-current assets and current liabilities and so on are. and also to do it in the North American style, which has some of the accounts reversed. The account numbers and names are the same, but where they are in the balance sheet changes. So we start off with current assets. It's not necessary to put cash in because it's zero, but I just want to remind all of us, keep us reminded that it is zero. But if you leave it out, of course, it's not wrong. So accounts receivable. Are 34,300. I should also note that this is the order in the North America. Its current assets are listed first, and they're listed in order of liquidity. Cash is the most liquid, accounts receivables are next, and then inventories. And inventories amounted to 15,200. And finally we have prepaid rent. Of 5,000, and prepaid fees of 500. So total current assets are 55,000. Non-current assets, okay, so non-current or long-term assets, and that's just machinery, and it's a net figure, so which means this is the net book value. We've subtracted the accumulated depreciation from the original value of those. And if you remember the number that we calculated, it was 28,210. So total assets equal 83,210. Liabilities. Starting with current liabilities. Okay, we had a bank loan because we ran out of cash. If you remember, 12,200. 12,200. We had accounts payable. With an ending balance of 3,900. And we had accrued wages at the end of the year. So accrued wages are 860. So total current liabilities are equal to $16,900. Non-current liabilities, or long-term liabilities, we often refer to this, is the term loan. And you remember we borrowed 10,000, paid 2,000 back, so the balance is 8,000 on the balance sheet here. So total liabilities both current and long-term equal 24,960. Add to that equity, owner's equity of 58,250 that we just calculated, and that gives us a total liabilities plus equity of 83,210. this must equal this if we've done everything right, and I think we have. I hope you can now go over your assignment and check what you've done relative to this answer, and if you still have questions, please don't hesitate to give me a call or an email, and I'll be happy to try to explain it more to you. Thanks for watching, and I'll see you the next time.